Philippians chapter 4, verse 13. I can do all things through him who strengthens me. Isaiah chapter 41, verse 10. Fear not, for I am with you. Be not dismayed, for I am your God. I will strengthen you, I will help you, I will uphold you with my righteous right hand. Deuteronomy chapter 31, verse 6. Be strong and courageous. Do not fear or be in dread of them, for it is the Lord your God who goes with you. He will not leave you or forsake you. 2 Corinthians chapter 1, verses 3 to 4. Blessed be the God and Father of our Lord Jesus Christ, the Father of mercies and God of all comfort, who comforts us in all our affliction.
Yo, my bad. Good morning, everyone. Had a little bit of technical issues this morning, but, we're rocking and rolling. Hopefully you guys had a good weekend or are having a good weekend. There's been a lot going on, to say the least, right? So, yeah, when market opens, it's probably going to be pretty dramatic. These types of things are used as, excuses and whatever. But, that immediately sets the tone for what kind of environments we may experience. But yeah, if you guys can let me know in the chat if you guys can hear me okay, see everything okay. And then I do want to pull this up as well. So this is the structure we're going to be doing. Okay. Going to have this type of structure for the calls. For those that may not know, or maybe are new, this is what the Sunday calls look like. Okay. I'm going to try to make it a little more time efficient. It may work, maybe not, because we obviously go deep into everything, depending on how many questions you guys have. So we'll see. But this is generally what the structure is for those of you that may be new, or for those of you that just want to have a Sunday organized process, something that you're going to do every single week. This is a very simplistic way of viewing things. Of course, there's a lot of details that we get into, but this is like a rough, outline and how you can structure your weeks in terms of what you're going to do, what you're looking for, or at least what I do and what I look for the most part. So you guys can take a screenshot of that. But yeah, so again, there's been a lot of stuff that's taken place in the last 48 hours. Obviously, there's, things going kaboom in a particular country. So again, you got to keep tabs on that in terms of the market, how it's going to behave. It's going to be a beautiful learning experience for anyone that hasn't traded through a war, especially with the U.S. directly being involved. I wasn't here for most of the wars, right? So this will be my first real wartime price delivery, aside from like the whole, Russia thing and whatever. But that doesn't directly involve us, essentially. I know for a fact that oil and gas are going to be heavily impacted. Where I live, it's already went up 5 cents just in a 24-hour period, right? So So yeah, keep that in mind. But hopefully everything can be done quick. Because if it does finish fast, which I don't know if it will, I think it's probably going to take a couple months. They're not going to go down without exhausting everything that they have. But hopefully it ends soon. And God bless the Iranian people, right? So yeah, just double check some stuff real quick. It's crazy too, because I have some students that have tried to work with me who live in Iran, and because of the sanctions and what this current regime has forced countries to do, none of the payment processors work from Iran, right? So you can't do anything. If it has to do with buying stuff, you can't, like, they're isolated from the whole entire world. So hopefully, hopefully the result of this is a positive one, and people in Iran can have a little more freedom to work with the rest of the world. Because it's not only the government that has, like a chain around it, it's also the people. Like commerce can't even be done. You can't even get into a private community use on Discord because the payment processors are entirely restricted. Of course they can use crypto and whatever, but yeah, it's crazy. So there's a lot of changes that may take place as a result of this circumstances going on right now. So, pray for everyone involved, and hopefully peace can occur and a better future can occur as well for not only Iran, but the world. So keep them in your prayers. But yeah, so as we always begin these calls with, we're looking at the news. OPEC Plus to way bigger hike after Iran strike. Yeah, see, it's one of the main headlines that oil and gas are going to be affected. I saw that Iran the leadership, basically is bombing civilian cargo boats, right? I saw like 3 of them on fire this morning. That's another thing. I mean, so if they're going out, they're going to try to, go out with a bang, just like if they had a nuke. If they had a nuke and they were losing, they would just drop the nuke and kill everybody, because they're not trying to go down. But, we have to be aware of this stuff because it directly affects the market. It affects oil and gas. If oil and gas becomes expensive, that means other things become expensive because oil and gas is needed for many machines that create certain products or do anything related to agriculture and whatnot. So if this continues and they do accelerate the damage they're trying to cause on their way out, food prices can spike, oil and gas can spike, many things can spike. Anything petroleum based can spike. Right? So natural gas, oil. So there's a reverberation that's going to take place. And the volatility, again, is going to be absolutely off the chain. So you need to be very cautious. We're not in a condition where you should think you're going to double accounts. It's possible if you, over risk and become aggressive. And some traders are cool with that, but I'm not. I'm not an aggressive trader. In some cases I am, but most of the time when I see the world the way that it is, or if there's certain news events and different stuff like that, it's best to be on the side of caution, okay? But again, so we have PMI coming out on Monday, basically tomorrow. Then we have no news on Tuesday. It's a non-farm payroll week, so you got to keep that in mind. There's still, I think, a partial shutdown in the U.S. That's another thing that's going against us. There was some really, really interesting earnings for companies like NVIDIA and many other big companies in the last week or so. So that's had a added effect onto the volatility and conditions. So if you've been feeling like things are a little bit harder and you can't get your footing, this is an explanation as far as why condition-wise. and why things have been a bit hesitant, why the NASDAQ has, kind of stayed sideways like this, right? But we'll get into that in a little bit. So yeah, it's going to be a pretty fireball type week. So, we got to see what it's going to do at the open. Don't worry about daylight savings time. It doesn't do anything because we are on 24-hour time. So there's no moving forward or moving back. It's going to all be the same, and everything calibrates so you don't even have to make any adjustments really. One thing you do want to keep tabs on, good morning, George and Chowezi, by the way. One thing we do got to keep tabs on for every quarter, right? The week before, week of, week after, a lot of times can bring you a little bit harder to trade environments. Then you add all these other things, and again, it's just a glaring sign that you need to be very disciplined with what it is that you're doing for risk management. This is not a time to go crazy. It's not a time to get 20 accounts and try to pass them all in a week. Slow and steady base hits is what's going to win. Like long-term investors, there's a lot of reallocation and adjustment, with their money. They're moving from certain sectors, from certain assets to different, more stable assets. It's a lot of realignment taking place aside from everything that's going on, because of everything that's going on. So, it doesn't really change our process overall. There's really nothing to change, but we do have to consider the risks. And, all we got to do is just be a little bit more cautious, a little more demanding. And if price isn't there, if it isn't showing you your model, you don't take a trade. Be very cautious, not scared, not fearful, not hesitant, but cautious. Remember the rules that we have, and remember why we have these certain rules, because this is the type of stuff that it protects us from. Having the rules that we employ for risk management, which is 1 to 2 trades a day. If you take a loss, cut your risk in half. Given the environment, you should probably start with a lower risk, maybe at least 25% less. So if you use 1%, for example, not that you should use 1%, but if you use 1% for this example, you would want to start your trading, especially at the beginning of the week, with either half risk of what you're normally going to risk or 0.75 of your initial risk. Okay, so you calculate that for whatever account size you have and all that, and then you figure out the exact numbers and whatnot monetarily. But yeah, don't overtrade and over leverage. 1 to 2 trades a day. Take it easy on Mondays and Fridays. This is just a rough breakdown of the risk management, some of the environments and whatnot, right? And of course, we're going to look at the DXY bonds and yields, Euro USD indices, and potentially get into the metals as well. I may also include oil and gas. So we'll see later on in the call. Okay. So yeah, again, NFP protocol, think of power 3 for the week. Sunday, Monday, accumulation, manipulation. Sometimes that bleeds into Tuesday, but Tuesday and Wednesday, if it's going to be a, Tuesday or Wednesday high or low of the week, we want to try to observe that in here. So Sunday, Monday, accumulation, manipulation. Tuesday, Wednesday, expansion. Depending on how fast that is and where price ends up around Thursday and Friday, we could then try to adjust to either TGIF or it may just keep going, right? But if a higher time frame liquidity pool or PD array is met after strong displacement as a result of the beginning of the week and the middle of the week, you can expect TGIF will most likely take place up to 25 to 35% of the weekly range that was delivered, right? So that's like a static thing. So if these circumstances unfold where there's a displacement, say it's a bearish power 3, right? And we're going lower, and we went lower, and then by Thursday or Friday, we hit a daily order block bullish or a fair value gap, or we take out a previous month's low or previous week's low, then you can rest assured that, Thursday or Friday, depending on what day hits that, important area and price, that'll be used to kind of frame out the timing for TGIF. And then, of course, like I said, 20 to 35% of that weekly range could be traded into if we can calibrate and find that being the case, okay, in terms of TGIF. All right, so yeah, with that being said, we got macro positioning, contact, risk, economic news. Okay, so yeah, let's move on to the bonds and yields. So first, we're going to start with the yields. We've been talking about how, if this continues, once it stayed below this, we had a real opportunity to continue to frame price going lower. I did outline this ahead of time. You notice how that's an opposing PD array to the down movement. That occurred on a Tuesday. So this was a very rapid week. Let me see. Actually go down a little bit. So Friday, Monday, Tuesday. So yeah, this ended up becoming a reversal entirely. Was this a holiday? I think was it a holiday? Yeah, it's supposed to be a little gray line in that area because Friday to Sunday, right? Friday to Monday. For some reason, it doesn't have the Sunday there. Must have been because of a holiday or something. I don't know. Strange how it's missing the Sunday open there. It just says Friday to Monday. It's kind of odd. But we could see how it rallied up, right? Came back into this quarterly bullish order block as a result of the decline. Price hit this opposing PD array here, triggered that in as a reversal. Okay, not a reversal, but a retracement to then continue the drop. We see large wick in here, or a reasonable wick there, right? We took this low out, so all of this became a balanced price range. Once we got below this weekly fair value gap, it turned into a BPR as well. Then this retracement respected the 50% of that. You also have this high to that low with a failure swing. So this down candle here is a mitigation block. It's also a gap, a new week opening gap. So you can kind of see how that was respected. And you got one breakdown, shift in market structure with another one here, creating an order block. Price came back into it. You couple all those things together, and you see the reaction that we got. Then once it broke down below this, all these targets down here became part of the equation. And then, of course, we've got this retracement. You see the respect to this wick and this volume imbalance. Right, price came back up into it, closed below it. It wicked through it, but it closed below it. Didn't really show much more respect to this quarterly bullish order block, which is right here. We're still inside of it, but I don't think until we get some type of real displacement, it's going to turn around. I think that we now have these lows to be targeted here. Let's go to the weekly chart. Got this low. It took out that low, rallied up. So let's actually move up a little bit, see what's available there. We got a quarterly up candle here. We got this wick in here. So each of the quadrants is a target as well, alongside some of the other liquidity points that I have labeled here, like the low here and low here. But this looks like it's in jeopardy, right? We took this out. This wick here should be respected. We have this up candle. We have displacement followed by displacement. So that should be a BPR entirely from the low of this candle here up to the high. And we could see how it's treated as such. We have a breakaway from this fair value gap. It's acting as a breakaway gap. We got one change in state of delivery, a second change in state. So again, unless that gets turned off and traded through, the likelihood of this continuing to try to purge, say, this low, maybe even some of the gaps down here, like a new week opening gap, regular trading hours gap, it's pretty likely, unless, of course, it turns around and gets beyond this fair value gap. If it does that, then, of course, we got these highs up here. But again, that'll be a contingency plan, assuming that this gets violated. we could then talk about that. But for now, we may get a retracement back into this gap here. Okay. Price may come back into that, respect it. This was a market maker sell model. This was second stage distribution. How do you know? Because we see the fast-paced movement below that low. We got accumulation or consolidation in here. Accumulation, long reaccumulation. Then we get the smart money reversal below this low. First stage distribution, second stage distribution. Notice how once it broke down below this here, it never really returned on a closing basis above the high that created it. That's the accumulation area, basically. And you can see that we closed pretty solidly below this down candle, which again is part of the accumulation on the left side. So price has now resulted in a decline. So I think that's going to continue because we took this large previous week's low. We may open up next week, rally up a little bit for power three, right? We always got to think power three, set the high and then potentially go. I don't see this wick being taken. I for sure don't see this high being taken either. And if it does look like it wants to get up there, we may have to readjust. Remember that the bonds and yields have an impact on the other assets. The yields in particular, being this thing that we're looking at here, they have an impact on the DXY, and they have a reverse correlated impact on the indices and the foreign currencies. So that's why we start here, and that's why this is so important. Okay, so again, power three. Remember the news that's available this week. It's NFP week, so you got to have the NFP protocol, which I laid out earlier. But again, we still think power three. Most important liquidity is going to be this high to that low, right? So this high, it's previous. This is Friday's high and Friday's low. So if price opens up, maybe it takes Friday's low initially, and then gives a retracement. Maybe it attempts to get Friday's high, but stays below this down movement in here. This whole movement in here, from this low to that high, can be also classified as a larger potential market maker sell model. Okay. So I think it's blocking it a little bit. Yeah, there you go. So this low to that high going down below, you can actually grade that if it is going to, in fact, be a market maker sell model. In that case, we could see that we have accumulation or consolidation, accumulation, reaccumulation, smart money reversal. This will be the low risk sell, the initial sell that's kind of coupled with the smart money reversal area. We got that displacement, so we got first distribution. So if this is going to be targeted down here, we may be set to have one more distribution that shows up, which could be, in here, it could retrace up in. It should not get above this high, right? If it breaks this high or even gets beyond the 50% of this accumulation in this larger sell model, that would potentially put us in position to have to, be flexible and adjust to a market maker buy model potentially. So if this high gets taken on this side, and but in particular, if this high gets taken and all this area gets violated, this should be, if this is a sell model, a balanced price range, right? We have previous accumulation. When those were going higher, as you could see, they were creating balanced price ranges, continuing to push higher to a liquidity void up here, which again, if you go back, I called this ahead of time before this even got there. So this isn't, just on the chart. We called this whole move higher. And then once it was inside this, we watched this fair value gap. And then once it displaced outside of it, our intention was to target this. And I even said to watch this because it doesn't have any trading in there. That's what makes it a void, right? So it has no buy side or sell side in that particular area. So what did price do? It shot a wick up there, offered buy side and sell side, and then pushed away, rejecting from the high up here, changing market structure as well, going back to the downside. Okay. I think there is kind of a discrepancy, at least there was for a little while. We've had the yields going lower while the DXY has been reluctant, right? It's been retracing, coming back into basically this mitigation block here from this high to that low. Got a failure swing, displacement. All of this is a balanced price range. If you look at the daily chart, it's actually a bearish breaker as well. So, when we're looking at the yields, given their relationship, if this is going to keep going lower, eventually the assets that are impacted by the bonds and yields fall in line. Okay, they end up, really snapping back eventually, because that's just the way it is. This is how the market works. This is the relationship that the interest rate markets have on just the whole market as a whole. And in particular, the assets we trade, which are the indices. Maybe you guys trade currencies and metals as well, but regardless, inside this basket of analysis, these have a heavy impact, the bonds and yields. So that's why we start here, right? But again, as long as we don't break this high, and we stay below this low to that high as 50% level, any retracement is going to be looked at as offering a short-term premium to then continue to go lower. Okay, we got 75% down here. You guys know that if you're in a market maker sell model or buy model, but in this example, a sell model, if we reach down below into the 75%, and you can couple that with an accumulation that you found on the left side, and it makes sense for this to be a sell model, that is where you can frame out potentially with pretty high accuracy generally where the second stage distribution can form. We got the first stage. We got the low risk sell in here, right? Coming off the smart money reversal. We got respect to these PD arrays. Order flow clearly is showing that bullish PD arrays are being violated. Bearish PD arrays are being respected, right? And then, of course, like I said, we have this as the foundation, the market maker sub-model framework, clearly outlined, right? You could see it. It's kind of a mess all over the place when it comes to the accumulations, but you can spot them, right? They're fairly easy to see. And if you have a hard time on those lower time frames, like the daily, just move up slowly and see if scrunching the pieces together starts to make a little more sense and justify a little further, okay? So yeah, I guess that's kind of my opinions so far. See, the 30 years is definitely the lagger. It's lagging behind. It's lagging behind for whatever reason, the 5 and 10 year. For the 10 year, I see this in here. We got a monthly low. So before it gets even into this, we got this monthly low here. Notice how when it traded into this wick, it treated it as a balanced price range, closing above the 50% and then rallied. If it would have broke through that after a retracement in here to this, obviously we would have been able to see this as a continued down movement, but it had other plans, right? They wanted to retrace a little bit, but now we're here, right? Market maker sell model for the 10 year as well. We have a market maker sell model here for the 5 year as well. And we have pretty blatantly obvious targets with trendline liquidity as well, just for a cherry on top. Okay. We scrunch this down too. We got trendline liquidity here as well. What's retail thinking? It's going to tap it and bounce higher. That's what they're thinking. They may be in given the circumstances, they may be in a better position to catch the breakdown and then return back into the lower portion of it, the other side, get that flip. But we don't think that way, right? But we could see how they're thinking. So yeah. With that being said, these are my invalidation levels. This is my thoughts on the yields. This high, preferably we stay below this wick and this up candle. I mean, preferably even we stay below this, right? This area in here, and just really use this down movement as an inverted balanced price range that used to be bullish over here, turned bearish. It's been fully respected at this point. But again, because we took this low out, we may be in a sell model. I think that's what the case is, but that doesn't mean that it can't open up, rally up a little bit, go against us, try to fool you, and then give up the ghost a little bit later in the week, given that it's NFP week. So timing is going to be very important. We don't just because we're bearish, we're not going to go in and just assume. I'm sure there's going to probably be a pretty nasty gap across the board on most assets. It's going to be an excuse used to break things. So keep that in mind. Have that as an expectation. So yeah. think that just about does it for this asset. Do you guys have any questions? Let me know if you guys have any questions, and if not, we will move on to the next segment. But yeah, I hope everything makes sense. You could just throw a 1 in the chat if everything makes sense. And Tony, I'm more than happy to do currencies or cryptocurrency too. Let's see if we have time. All right. Okay, so with that being said, move on to the bonds. You see that inverse characterization, right? So, moving on to this segment with the bonds now, we can kind of see that inverse correlation. Price is pretty much, rapidly repricing higher. Keep in mind that the bonds have a positive influence or a positive correlation generally with the indices and the foreign currencies. So if this is going higher, it may see a turnaround at some point, but we're just going to have to wait and see what happens. It may not be as exaggerated, right? This whole movement may just encourage a retracement, given that seasonality is super bearish around this time for the indices. So we got to keep that in mind as well. I think that in let me see. I guess the indices have a slight bullish tone. And the T note, now this is a great thing. So T note, that's the 10-year, right? That's or that's the T bonds, right? The Treasury bonds. That's this. If you notice, there's a rapid rise. There's a slight decline, but a rapid rise going into March, where all the lines agree. I don't know why I don't have the 5-year on too, but the 5-year agrees too. It's a little less for the long term. That could mean that there's slight inconsistencies at times. It could be bullish or it could be bearish, depending on the world and what's happening with interest rates. But overall, going into March, there is a tone shifting, looking like it wants to continue to rise. So, with that seasonal influence, right, that potential characteristic, if we go down into this asset, right, or, just on the chart, we could see that that's had a pretty nasty impact, right? Well, a positive correlated impact. So it's very fascinating. Sometimes, things could be hit or miss with seasonality, but it's a good reference. You always want to look at it because it is a treasure map, essentially. Okay, so we'll keep that in mind. But yeah, so we've already taken this high out here, similar to this right here. I took the low. So given the fact that we took this high and, these are reverse correlated, if whatever I think the yields are going to do, I think the bonds are going to do the opposite. Just like with the euro and the dollar. It's very much a similar relationship, almost identical actually, because the dollar does the opposite of what euro does in the indices, right? And vice versa. So if one goes lower, the others should go higher. Same with this. The only I guess slight difference is this impacts a multitude of assets. You know what I mean? The bonds impact, like I said, the currencies and the indices and the metals, while the yields impact the dollar. So just like we said on the yields, if that's going to do a retracement to try and go lower, we're going to possibly see this retrace. We have this wick in here, right? Remember this high and that low, very significant. It's a previous week's high and low. Anything that's in close proximity PD array wise or higher low wise, right? Like this low here and this high here, this wick in here, this wick in here, this little gap in there. Because it's where price is at, they're significant. These PD arrays down here don't matter. We already pushed away. I can honestly remove that. all of this doesn't matter. Only thing that matters at the current moment is this fair value gap potentially, but this wick, the order block here, and these wicks in here as well, and the little gap in there, and anything else that's in close proximity to where price is at. You take that plus the current high and low of the week, current high and low of the month, right? If you go into the monthly chart and observe that as well, I'll leave that for you to do. And then, of course, on the daily chart, the most important thing week to week is Friday's high and Friday's low, because when price opens up, we're going to open up inside this candle, unless it gives a gap, which very well could happen, you know. But my overall intention for maybe the week, if it gets really excited, or maybe the next 2 weeks is going to be to see if we can get price up there. If that happens, again, there may be strong bullish retracements happening in the NASDAQ and the indices, unless they just turn around entirely and upset the down movement. But, you know, we'll discuss that a little further in a little bit. Okay. So again, because this is the opposite, we don't have to spend too much time. It's opposite with the yields. So whatever that's going to do, we think this is going to do the opposite. So the yields potentially going lower. This should potentially go higher. Open up, look for the liquidity I just mentioned, and think of power 3. So if it drops lower, if it tags this, which is a gap in here, you can see right from this high down to that candle, that is a volume imbalance. So you can drag that out. It's I think a new day opening gap, to be exact. Could be wrong. But it is a gap, okay? So a retracement into that, I'd expect to see respect this high to that low, 50%. It's part of the line in the sand. Another part of the line in the sand is the low here. We do have inefficient price action in there. You see the discrepancy between these candles. That means that there's a gap of some kind on some time frame. So you got to mark off the closure of that with the open of this candle, and that gap in there could end up becoming significant. I'm not sure if it was a holiday or something. Maybe it was. I think it was a holiday. We did have one recently. But yeah, so trading down into that, maybe it tries to attempt it. But again, from this high to that low is 50%. If this is going to be a fast-paced bullish run and we're not going to see a deep retracement, we shouldn't even attempt to get that. If it attempts it, this may be looked as a potential counterparty target for a continued buy. And then again, if this fair value gap gets violated, we've already broken through many PD arrays, right? So the swing low, we'll have the up candles in here turning into a bearish order block. We have the 50% of this high to low breaking. Then we'll also have a pretty strong response to observe from this previous week's high. Couple all of that, and then we break this, you know, you'd have to adjust your narrative to being bearish. We have a high here, low, higher high, turn into a bullish breaker. I'm not going to mark it off, but this is also something in conjunction with this that would have to hold if it trades down into that. You know, it could, and it won't upset things, you know, initially if it was to do that, but it would mean short-term adjustments have to be made, okay? But yeah, with that being said, is there SMT there? Yeah, there's no SMT there either. So, but yeah, with that being said, that's pretty much all I have for the bonds and yields. Remember, just to reiterate, the bonds and yields, well, the bonds initially impact what the currencies and the indices are going to do. The bond yields, right, or the government bond yields, this impacts what the DXY is going to do. Okay, it's that inverse nature. And the most highly effective trending environment is going to be when price is trending in your asset and you can see that the bonds and yields agree with that trend you're observing, right? And of course, you couple the others because this is an entirely complete risk-on, risk-off analysis. So, and that's market symmetry at its finest. And market symmetry is one of the very first things, if not the first thing, that measures whether we are in a high probability condition with a strong trend that you can trust. Okay. So yeah, hopefully that makes sense. Yeah. But with that being said, we will move on to the next segment. So do you guys have any questions before I move on? This gives us a great baseline. It gives us a great baseline for what the other assets are going to do, okay? So just throw one in the chat. I know there's kind of like a lag. It's a pretty heavy lag for some reason. So yeah, throw one in the chat if it makes sense. Hopefully this is all, review for many of you. But yeah, if you're new and you watch the replay, definitely don't hesitate to ask a question. I'm more than happy to help. But yeah, with that being said, we will move on to the next segment. So moving on to the dollar index. The dollar index, I mean, it's had some problems the last week or so. We've obviously been mapping this whole thing out accurately for months, at this point years too, for those of you in my private group. For those of you here on YouTube, for the whole year last year, and this year's really been no different. So again, just like with the bonds and yields, that process, right? We're looking for the most recent high and low, right? Close proximity PD arrays, right? Like in this case, we're respecting this, very much so, right? It's rejecting this wick in here. So it looks like we may look to continue to drop if it's going to fall in line with the yields, because that's what impacts this internally, right? The bond yields, and the bond yields are declining. We may see this snap back, right? It may snap in line, and then eventually we may see the other assets rebound as well as a result. There's a pretty nasty correlation issue where things are a bit all over the place because of the war and all this stuff. But let me see something. But yeah, so again, looking at the DXY, we have the highs here, Friday's high and low. It's daily chart, right? Yeah. So Friday's high and low, price is going to open up inside this range, but then also it's opening up inside of this current candle, the previous candle from Friday. That's what puts Friday's high and Friday's low in the realm of significance when you start the week, right? Every week. It's just a reliable process that we do here on Sundays. And again, you look at those highs, you look at the previous week that just passed, the high and the low. So we got the high here and the low here. We're opening up this week within that range. So that's our liquidity pool, this or that. All of this, extreme down here, extreme up here. Yeah, that's great to be correct on, right? But again, what's in close proximity? You just need to know what the next weekly candle is going to do. Where is it more likely to reach, this low or this high? If you can determine that, you have bias and narrative every single week. You don't have to be correct like we try to be for months on end, accurately, I might say, right? You can get there eventually. But if you're a day trader, a lot of people don't use the quarterly chart. I encourage you to use it, and the monthly chart and the weekly chart, because some people that scalp, it's too much for some people, right? But over time, it becomes a lot easier, but it's highly effective. You want to be in line with the higher time frame, the weekly. If you can be in line with the quarterly chart, you can imagine your narrative stays for a long period of time. This is why I always say that we have this higher time frame analysis, and it takes a lot for this, bias or narrative to shift on a larger term basis, because it's like a ship. It's like a big ship needing to turn. Those higher time frames are slow, just like how a ship is slow in turning from one direction to the other. They can't just, turn like a NASCAR driver and just whip around, right? Or like a street racer. It takes time. Things have to unfold. And that gives you time. It gives you the ability to hold on to a narrative for weeks, for months even, if you get it correct on the super higher time frames, that being the quarterly, or even the 6 month time frame. You could do all this stuff on that time frame as well. But specifically the 3-month, monthly, weekly, daily, that's where I live. If you didn't want to use the 3-month, you definitely should still use the monthly chart, even if you're a scalper, because if you have the biggest portion in terms of the time frames behind your scalp, it's a little bit more confidence boosting. And what we do here puts you in line with how to do just that, right? How to be in line with those higher time frames. But again, for DXY, we got this high to that low. So the Friday high and low, we're going to open up inside of it. So that's our very first initial liquidity that needs to be targeted. We have to frame which side is going to be targeted first. And then going into Monday and Tuesday, hopefully one of those is taken by then. And then we could use that as potential counterparty depending on what price is doing on this asset, but also in the others. And then we could determine where is more likely. Is it this low from previous week, or is it this high? And if this continues, right, it has given some signs, some life that price may want to, continue to decline, right, with this rejection up here. We got to see how this order block is treated going into this next week. If this is respected and it displaces above this high, that builds a pretty solid argument that we're probably going to look to seek buy side, and it may look to amplify. Along with, this being a breaker here too, this high to that low. If you go to the 4-hour chart, or even the 16-hour, high, low, potential higher high, if it stays up above this, say this decline in here is short-lived, and we get displacement above this high, that's the weekly high, right? We'll look to target previous week's high, which is equal highs too. And we got a little bit of this gap in here, but we're in consolidation, so it can do either. So we got to kind of sit on our hands a little bit for DXY. We do have our liquidity here and here, so we'll see when we get more information what it's truly trying to do. But things that we have to look at for now to kind of help start determining what it could potentially do. We're inside this quarterly fair value gap, which I've used for, like the last 2 years. It's been important that long. It just shows you how those higher time frames give you longevity in analysis. And it's been responsive at the levels, the quadrant levels, every time, right? The 8th here, 50% here, 8th here, 75% here. Make that a little bit more precise. And yeah. So we inverted this daily fair value gap I've been talking about. And again, we got this breaker in here that I just pointed out. So we're going to have to see how it's going to treat this. If it respects this wick here, and we get a change in state of delivery, basically the down close candle comes off of this, and it turns to a bullish candle that breaks the highs, again, we may look to target this first. This rejection in here, we're trapped in between this up movement, down movement, right? This breaker in here. It's also a higher time frame order block. And it's also a monthly wick. Okay, like if you go to the monthly chart, it's a wick in there. Okay, you can see the respect to that. So, if that continues, it's starting to, really lean towards us potentially continuing to drop against all this move higher. So, again, because it's sideways, you have to be flexible. You have to allow yourself to admit that you don't know 100% what it's going to do. It could do anything. If we're just going to go off of this weekly chart, clearly it was a decline, took stops, came off those stops, and now it's a retracement. So depending on if it rejects here, we'll be continuing the bearish move. But if it breaks this high here, respecting this order block, we came off of a stop run down here, came off of this wick, created a change in state from this order block, and then a respect of that order block, once it gets above this high. I mean, that's a really huge, clear adjustment from bearishness to bullish being shown in the chart if this is what unfolds. So, my line in the sand for any type of, assumption that it's going to be bullish, right, is going to be if we break down below this low here. Because then that wick may turn into a balanced price range. Now, because price is currently going sideways, right, if it returns to the midpoint, it may look to hang around in there. You never know. But breaking down below this, maybe returning back into it, using it as resistance, that could be a pretty solid indication that price is going to go lower. As you see, I have LIS, line in the sand. So again, I've had that for the last week or so. So we mapped this out ahead of time. So we'll see if it gets down there, how it wants to treat it. But if it's bullish, we have this wick, we have this overtaking of the fair value gap on the daily. So it should act as a balanced price range and go higher, be an inverted fair value gap. And then we also have this wick in here. And then we got this wick that respected that wick. So this midpoint on this one was respected and it went higher and rejected. This wick, 50% level, is now being flirted with. So we got to see when it opens up, what is it going to do with those areas? Is it going to respect them and then give us displacement and a change in state? Maybe gets us above this, maybe takes out the weekly high. Because in that case, we may not be done looking to go higher. And we may also see this transition from this decline to a market maker buy model. Now, one more consideration. If this low is taken and it does prove that it displaces through it, returns back into it, and then gives another displacement, you could look at this low to that high as a small market maker sell model. Maybe not so much small, but a daily market maker sell model potentially unfolding as a framework to target this low. That's if this gets taken out, because if not, again, it's just going to respect the underlying idea in here. You can kind of see how we're trapped in between two perspectives, right? The decline on the weekly, just simply retracing to go lower. In the daily chart, with this huge displacement higher, respecting the bullish PD arrays. That's a very clear sign that price can do, either one. So you have to wait for more information. And I'm not a liar, and what I do works, and it's very, very objective, right? Things are going to either work out or they're not going to work out. And if they work out, great, we know what to do. If they don't work out, we know what to do about that as well in terms of our flexibility protocol. It's in the invalidations and all that too, right? So again, if you look at 3 PD arrays from this daily chart, we have the low here, we have the wick, we have this wick, and we have this inversion fair value gap. So again, if it breaks that, we're starting to give up the ghost to the downside. But if it respects that, then we're going to continue to see the price will go higher. But again, my main perspective is what I've outlined here. I would like to see, if this is going to snap in line with the yields eventually, and say the yields are going to continue this down movement, I eventually want to see the dollar fall in line with that. So that would mean this low gets taken, inverted, right, used as a bearish PD array, and then this gets taken out, and then this gets inverted, and then we head on down to these larger targets for the next couple weeks, maybe even for the next quarter. Because we're pretty close to the new quarter, we have 2 weeks. It's 2 weeks out. On the 16th of March is when the new quarter starts for the second quarter, which is my favorite quarter, by the way. It's the best. Generally, around this time is when things get a little more clean, but we're going to have to see because there's a lot of stuff happening. Those are wrench in the equation. But yeah, we'll see going into the rest of this week how this wants to respect or disrespect these levels I've outlined. Okay. But I would prefer, if there's a gun to my head, I'd like to see if this can hold. If that doesn't hold and the daily chart breaks down, it's going to be a very, very clear example of how even if a lower time frame shows you something, even if it's like the daily versus the weekly, the daily chart's going to be subservient to what that weekly perspective is going to do. And this continues as you go up in time frames, right? Like the weekly chart is subservient to the monthly chart. The monthly chart is subservient to the quarterly chart, so that's why it's good to, cross-reference. It just builds clarity, and confidence in whatever it is you're trying to observe. So yeah, we'll watch this low, previous week's low, previous week's high, Friday's low, Friday's high. Those are our initial targets plus this. So, we'll see how it wants to treat that little basket. And then depending on, how it, responds to those, assuming that it does give us some type of movement, we'll be able to make an even more sure decision But again, gun to my head, I'd like to see how this wick holds. If it holds and we displace, maybe getting above this, that'd be great. It'd be a change in state, and we can look to try to go higher again. And if we take this out, we may be more long-term bullish, potentially, if that continues. But if it breaks down below it, we'll look to see if that can be an inversion. Look at it as a bearish PD array, and then we'll see if it can hold that, and then maybe go lower. But yeah, so for now, we got to be flexible. We got to have that mindset, because if we go in demanding something, it is what it is. You could be wrong. There's nothing wrong with being wrong, but the way that we do things with what I've just outlined, it gives you the chance to corner price regardless of what it does, because there's no 100% inside of a consolidation. So we got to wait. Okay. So yeah, let me know in the chat if that makes sense. Again, if this is going to follow the yields and we do snap back at some point, it's more likely that it's going to break this low. If it does break that low, we have supporting factors with the yields to really, really drive home the point that it can be trusted and go lower. Okay. But for now, my main perspective is, because we're in this wick here, I want to see how it treats that. And this breaker in here, right? This up candle. And we're staying inside of that range. So we'll see. Okay. Appreciate you, George, for confirming. So now let's move on to the next segment. That next segment being the currencies, right? So let's look at what the currencies are going to do relative to the overall analysis we did on the DXY bonds and yields, so on and so forth. Okay, so with price retracing in here, depending on what the dollar does, right, that's going to determine what these are going to do. So if the dollar does, in fact, look to have a rampage to the downside, we'll see the currencies also start respecting bullish PD arrays, and then things like this will get violated and then turn to inversions. This low here, high, lower low, should end up becoming a bearish breaker if it's going to be bearish. But again, if the dollar starts to show weakness, we may see this end up getting above here, and then we'll take this high to that low with a stop run. If we get displacement above that, that'll be looked at as a bullish breaker, and that's how you can, kind of get in line with bullishness, depending on what the DXY does. We are still kind of range bound for the currencies. There's a lot of stuff happening in the world, right? So that's, not unlikely to see what's been going on, right? We did get a pretty rapid decline. I called this short in here for the currencies, called it down into the suspension block here. It's worked out pretty flawlessly. I did talk about this as well a couple weeks ago. If it respects this and we start to break down, we got a balanced price range, and then price will continue to try to reach for these lower prices. And as it broke down through these PD arrays, we were continuing to observe the respect, right? I did point out this wick last week. I wanted to see how it was treated. It did start to respect it, but then it gave one more punch higher. Dollar didn't really have as much excitement as it could have. So as a result, the assets that are affected by it, they also kind of had a very interesting, slow, rapid back and forth type of movement. Slow as in the range, wasn't really too aggressive. In terms of breaking out of anything, it just kind of went back and forth, right? Higher, lower. Same thing happened on the indices. Very exaggerated, but you kind of see, what the result is with all the stuff happening in the world. It's a little bit more hectic, right? So you got to be more demanding. We have this high to that low as well for the GBP. That's a mitigation block. Price is trading back into that. So again, unless this high is taken and the dollar declines, we may still look to see this continue. We have a bearish order block here. So again, if we could take out this bearish order block, take out this wick, 50% level, and take out this high, that's 3 PD arrays to turn us back bullish, especially if we can couple that with DXY bearishness, right? Assuming that takes place. But again, we got to see what DXY does. But that's a scenario to watch. If it does continue to drop, then we should respect this order block here. And if it, if that is the case, say it opens up, maybe takes out Friday's high here, and then, breaks down through Friday's low, we may be able to see that act as displacement, the initial displacement to get us down into here. Maybe it sets a Monday or Tuesday high of the week. And then we slide pretty aggressively. We have relative equal lows down here too, so that's a pretty reasonable target. Anything beyond that, we'll have to wait. We'll wait and assume. I can say that if this does get taken, my attention goes directly to here because this is inefficient. There's not even a wick inside this little tiny piece of the fair value gap in there. So that's what the algorithm will gravitate to. It's like a heat-seeking missile, and that's the target, So, but yeah, that's assuming that, this can be taken out. Before all that, we got this low here. It's previous week's low. Okay. It's the previous week's low there. So if we do get that order block to hold, then we should be able to see it continue off the mitigation block here too. So mitigation block, we potentially have a low, high, lower, low breaker, which is also on this time frame. It's an order block. It's a breaker if you go down in time frame with this swing low. And then it's an order block here. Order blocks are balanced price ranges. Breakers are balanced price ranges. So, if it's going to go lower and it's trustworthy, it should respect that, right? Because that's just the way that it is. And there can be an argument against it, but we see every single week these types of tools. They work, right? It makes sense of price more often than it doesn't. So yeah. So I guess that's really all I have for the currencies. We're just going to have to kind of wait and see what it wants to do. There was a SMT here at the highs, so kind of resulted in this decline pretty aggressively. Notice how the GBP had the failure swing, so it was the more pronounced move versus this one, right? I guess it was kind of similar. It's kind of similar. But yeah, this failure swing, it ended up picking up a little bit more aggressive. See it, the stall out there, some displacement, but these two candles were much more rapid. I guess there's an argument it's kind of similar, but yeah, the one with the failure swing when it comes to SMT, it's going to be the more pronounced move. So if it's bearish, the failure swing asset is going to be the one you want to try to pay attention to. Or if say the euro took the low here, but GBP didn't, which I think was the case, right? Yeah, it was the case there. The GBP would be the faster moving market, okay? So yeah, and of course, there's new week opening gaps here for the currencies as well. So all these gray lines, those are new week opening gaps. So wherever price is at, you want to look to the left and see where's a new week opening gap or a couple of them from previously that are in close proximity that can maybe be used this week. We got this one. Got this one here. You notice how the low in there respected it. Got the close here. Oh wait, no, the close there and the open there hasn't got to it actually. We got one in here. Didn't really get to that one either. We do have this one that it messed with, right? The closure here and the open of this candle. You could see that it was very respected, Just another reason why prices kind of stalled out in that area. Aside from what the dollar's doing, you know what I mean? So yeah. And that about does it for the currencies, right? Do you guys have any questions about the currencies before I move on to some of our final assets, being the indices and gold and silver, and then potentially some crypto if we got time? Let me know in the chat. If you don't have any questions, just throw a one. Right, beautiful. So yeah, with that being said, let's move on to so with that being said, let's move on to the 3 indices, one of our final segments. Actually kind of clean some of that up real quick. So we see DXY down here. I've been doing this recently, just keeping the DXY on there. I don't trade the Dow, so I don't really care if it's showing the full thing. I just need to know where the highs and lows are at, and then what DXY is doing in the same moment. So, you know, if DXY does end up tanking, it may upset what we're about to talk about here. If we look at the weekly chart, we can see how there's the wick here. We respected that. We basically took out a previous week's high, kind of left the monthly high. And the drop up there too, we outlined it with the SMT. So looking at that, we got the wick in here, we got a wick in here, we got the wicks in here. You can kind of see that we're stuck in between wicks with the quadrants in this one, quadrants in this one. We do have the failure swing down here that I really do like. I want to see if we can get down into that. You know, I don't see why we wouldn't be able to if it continues to be bearish. One stark observation we could see right off the bat, looking at this higher time frame in here, is the fact that it's just absolutely disgusting back and forth. Price is also overlapping candles, right? The previous candle is overlapping the other one. That is a clear tell that we're in high resistance, low probability environment, at least from the weekly chart. Okay, so on a longer term basis, we got to do something about this. It's going to have to break out in some way. And if it doesn't, we may still continue to see stuff like this, right? Rapid movement, taps a level, declines. Maybe get a rapid movement, tap a level, and then rally, go back into this consolidation. So, we'll see, right? It looks like it's not. It looks like it's reluctant to want to go higher. So we'll see if that wants to continue. There is a slight, like we talked about earlier, a slight bullish seasonal influence for the bonds. I believe if I can go pull up the S&P. The S&P has, you can kind of see that all 3 of them agree at the start of March. Going into March, there's a low that forms that then results in a slight interest to want to rally. We could see that all throughout February, there was a bearish seasonal influence. And we could see that, it's pretty solidly fell in line with that seasonal influence, right? And now that we're going into March, look at what happened going into March, right? It declined, had a very sharp decline, knowing that going into March, there's a bearish seasonal influence, at least for a short time. Okay. And you could see how perfectly the alignment with what's on this chart here, the seasonality chart, with what price is doing. It's not always picture perfect like this, but it is a heavy influence. It's like a treasure map, ICT calls it, right? And once you learn over the years what seasonal influences are the most effective every month, every year, or every other year, you start to have an expectation every time you go into a month what the narrative could potentially be. You take that historical anticipation skill from this tool, and then you apply it to real-time price action from this higher time frame, and then you can justify, if, say, you're bearish going into whatever month. If it makes sense, right, like something like this, it took the buy side, rapidly changed state of delivery here on the daily chart. If you can couple that with a bearish seasonal influence, it just starts to make more sense. It makes it more high probability that narrative is going to unfold. So I hope, I hope I made that make sense. Did that make sense to you guys? Because hopefully what I just mentioned is, showing you how seasonality can be used, how it should be used, because seasonality gets a bad rap. People look at seasonality chart, they look at it for 5 minutes or a week, and then they're like, okay, well, if it's seasonally bearish, it should be bearish. And then all of a sudden it does a retracement. And then they say, oh, well, it doesn't work. And then they never look at it again. And it's highly unfortunate that that's how people have their mindset, or that's where their mindset's at, for seasonality and COT too. It's the same type of thing. These are macro tools. They're not 5-second tools. So it's not going to be very useful, in the grand scheme of things, if you're using the 5-minute chart, 5-second chart, and that's where you live. But it does reinforce what happens on that 5-minute, 5-second chart, whatever time frame you're on those lower time frames, because you have back-end historical data supported by higher time frame analysis to justify why you should take a short on that 5-minute chart when you do, at what part of the month, right? At a certain time of the week, right? At a certain time of the day, at a certain portion of the hour, right? You can see how you go down, right? It's like a microscope or a telescope, right? You keep zooming in from the higher time frame. That's the broad view. And then you get down to the real precision elements that we talk about that ICT teaches. And everything together makes you a well-rounded trader. But again, seasonality is very powerful. So with that observation that we just looked at with seasonal influences for S&P, it does show that sometime in early March, maybe going into mid-March, there's a low of some kind that may form. So in mid-March, or maybe even in here, if it does look to continue to rally, we may see that seasonal influence kick in. But for now, the start of the month of March, there is a pretty strong bearish seasonal influence. So that kind of supports that this is going to hold. And if, say, DXY stays cracked in correlation and keeps going higher, it'll just further reinforce that we're not done. We're in an overall bearish market at the moment. It's not bullish. So bearish seasonal influences are going to hit a lot stronger than bullish seasonal influences. Bullish seasonal influences in a bearish trend. Here's another key element for you to write down. Bullish seasonal influences that you see on that seasonal chart in a bearish trend is going to allow you to outline reasonably, with reasonable precision, where retracements may be likely to unfold. Okay, so if you have a bullish seasonal influence and the underlying market at the moment, because of world events, is bearish, instead of following them as a overall narrative tool, right, you could then adjust with the tool and use it as a retracement identifier. Okay, so again, just to reiterate, if you're in a bearish trend and you're using seasonal influences and you see that the seasonal influence is bullish, but the chart is showing you, because of what's happening right now, that it's bearish, you use that seasonal timing for retracements, timing retracements, and making sense of retracements, right? And that's another quirky little way to use seasonal influences that I've learned over the last almost 7 years. It's highly effective. It's understandable when people say, oh, seasonal influences don't work, and they haven't even used it for a month, let alone a couple years. People that have been trading for a while, for years, almost a decade, that use seasonal influences or have referred to them over years, I mean, you get to see a lot clearer picture of when it should be used, how it's used, why it's used, what it affects, when it's effective. And when it's not in alignment, what does it tell you? Because ICT has explicitly said, when seasonal influences are not in line, that's also telling you something. And what is it telling you? It's telling you how to frame, or when you can frame out in terms of timing throughout the month, how you can time retracements, how you can make sense of whether something's just a retracement, or if it's entirely going to turn around. But it's very important to understand that it helps you with the timing element. It helps you identify significant seasonal highs and lows. That's another powerful thing that seasonality helps you identify. And it's very consistent in that regard. I mean, it is a shocking consistency when it comes to the highs and the lows seasonally being formed. when referring to the seasonal influences. I mean, I'll let you go do that study. I'm not going to obviously do that here, but I mean, it's worth a study. I'm telling you. I've said this before, and I'm just saying it again because I still hear a lot of stuff and see a lot of stuff about seasonal influences, and people get bored. Oh, don't talk about seasonal influences. It's like, dude, like we have a process. So we're not going to break the process because people are lazy. You know, it is what it is. Or have an attention span of a gnat. That's not my problem. That's not anyone else's problem. That's a you problem, right? And it's unfortunate because, you know, that's why there's levels to this. You know, and there's some people that succeed and some people that don't. And seasonality is not going to make or break you, but the mindset, right? The lack of patience, the lack of discipline, lack of taking good advice, the lack of actual study versus trying to find signals, that is why people fail. You know, I can't guarantee success, but I prove that what we talk about here works. So, and if you study it and don't be in the camp I just described, you have a really good chance. And you give yourself a really good chance of gaining clarity. And then once you gain clarity, you take it the rest of the way, which is the whole purpose of what I do as a mentor in my apprenticeship, in my private group, and here on YouTube, for those of you that lend me your ear. So yeah, again, the seasonal influences, if it respects this order block here, you know, if it returns back into that and rejects, say there's a bullish candle that forms that gets violated, you know, that puts us directly in line with taking this out. And if it takes this low out, we then have a bearish breaker to go off of. So you could honestly, if you're not sure, right? Because I mean, it could do, you know, whatever it wants. You know, things can snap back into place, and then we could turn around and break this entirely, and then start to run higher because of the bonds and yields, and maybe things change. Maybe there's a good event that happens. Maybe there's the war that ends that's currently in play. You know, if that comes to an expedient end, you can imagine that certainty will come back into the market because things will stop, or at least chill out a little bit, and then you know, things may snap into place with the bonds and yields. But you know, how we open up, how we use Friday's high and low, how we use the previous week's low, previous week's high, and then anything that's in close proximity, right? The wick here, this bullish order block. I've been talking about that the last couple of weeks. It's continuing to hold right here. So if that continues and price respects this, and then price displaces through the midpoint of this bearish order block, which is also part of a larger breaker, that would set us up to target the buy side. You know, we don't necessarily need this high to be taken out. I personally just need the midpoint of this to be targeted and then traded through off the heels of it respecting this, and respecting this. That's 3 PD arrays bullish that are being respected that just refuse to be broken, right? That's clearly telling us that order flow is not really interested on a rapid basis to continue to go lower, and things are changing on the back end. We now also have SMT right here at the lows. Not sure. Yeah, let me. So we got SMT at the lows here. Again, we have the wick midpoint being respected. It's a weekly wick. So you got the weekly wick in there. It's a little bit off, huh? It's a little bit off. I'll just pull it down to there. So yeah, we got the weekly wick here. It's being respected. We'll see, right? But if we're going to look and see this be bearish off the heels of this run from the high, because, you know, we need real evidence that's going to go higher, given that it's sideways a bit. We've had rapid buy side and sell side. We're kind of respecting both sides of the market. This bearish breaker here. Kind of remove some of this stuff that's unnecessary. So we got the February open. So it came all the way back to the open, took the previous week's high, and then rapidly decline, changing state of delivery. This is something that you want to see if you're bearish, right? We got a stop run. We got to respect it to the higher time frame breaker. With this down candle, it couldn't even get above it. We triggered those stops, and then we changed state of delivery. So again, we're going to open up, see how Friday's high and Friday's low gets treated. We got a lot of gaps in here that price is potentially going to refer to. There's a lot going on in this area. We're in consolidation. It's bouncing back and forth. But if it opens up, this is what I would prefer to see if we are going to continue to drop. If it opens up, it needs to respect this order block. I'll be 100% certain if it can respect that. I think it's more likely to go lower than it is to go higher. Again, unless it takes out the midpoint here. I'm definitely more on the side of it being bearish, given what we see. We got this inversion on the daily. We have a change in state. So preferably, we don't even try to target Friday's high. Preferably, it opens up, maybe tries to reach down a little bit, pulls back, gets us above the open price here, because that's where it's going to open up. I'm not sure where the gap is going to be. There's going to probably be a massive gap today. So, I'll keep you guys in the loop with that. I'll observe it and send out a screenshot of what happens. But just keep in mind some of these things that I'm talking about, right? On that lower time frame, you see the higher time frame inversion for value gap I have. That is this here. So from that higher time frame, we see the change in state from that daily order block. As you drop down, you see that this was a buy model. Now it's kicked in a potential market maker sell model. This is something I sent out on Friday when we were observing it, seeing what price was doing. What's this? So we got this low to that high. Accumulation in here. We only have one accumulation. It's in a hurry, right? So one accumulation. So you take the high up there to the low. You drag that range over. And if price is bearish and this up movement, down movement is going to create a balanced price range, and the change in state is going to be respected. This is also another reason why that 50% of the order block on the daily should not be traded to. It's a balanced price range, buy side, sell side. You can see the reluctance to want to get up into that level because this stuff is what's really happening. This is how it works. This is just what it is. That's why it's not expected unless it's going to give it up to the buy side. It's not expected to go to the buy side. We're in a sell model now. So that's what my opinion is. I'm going to look to see if this distribution, it started, but I want to see if it's going to continue. And again, we have that bearish order block somewhere in here, right? It's inside this little range in here. I think it was inside this. I don't want to put too much on the chart. It's already busy as hell, honestly. But I don't want you guys to miss things. That's why I have so much, visually showing. When I'm trading, it looks like this. Maybe one or two things that are important. Of course, I have my chart here like this, but when I'm executing, I don't want to be swayed. And eventually, you guys will get to that point too, where you don't have to have everything on the chart always. And some of you guys will want a lot of stuff on the chart. There's nothing wrong with that, but you don't want to be reluctant to be flexible. And having too much on your chart puts more conviction, which isn't a bad thing all the time, but too much conviction in a move without the ability to allow for flexibility, that could be a problem. So again, there's a lot in this chart that is showing us it wants to be bearish. The current condition and all the stuff that's happening could upset things. So again, we afford ourselves the ability to be flexible. Where does that flexibility kick in? Once this daily order block is violated up to the 50% level. Let me map this out real quick from the body high to the body low. Oh, it's pretty close. Okay. So yeah, essentially, if this fair value gap gets taken out, if you want to keep it even more simple, or more precise, if this fair value gap gets traded through, that's our invalidation. Okay, the upper portion of it. Because again, this should be a balanced price range. So far it is. So far it's a market maker sell model. So far we have a massive higher time frame stop raid from a daily breaker. Also a daily order block, this up movement. But we also again have the daily breaker, right? This down movement, up movement. Oh, it's more of a weekly. Is it a weekly breaker? You know, it's a daily breaker. This low to that high breaking down, we return back into it. If this was the 5-minute chart and this happened, would you be overwhelmingly bullish, thinking that things are not going to go lower? Right? You wouldn't be thinking that. You'd be thinking, okay, it's going to go lower, right? It should go lower, right? Unless it takes out this high, right? Then that would be bullish. But, you know, given what we observe on the lower time frame and our understanding, we don't necessarily have to have it go all the way up there, right? On a higher time frame basis, you know, that fully confirms things, but we can really use something like this, right? The 50%. And again, the most important liquidity is Friday's high, Friday's low, previous week's low. We got previous day's lows in here too. And then we got this wick, and we have these lower PD arrays that may act as spots where price may look to retrace a little bit, create a little speed bumps here and there. But again, I want to see, just to kind of wrap it up here with the indices, I want to see if price can open up, rally up into this order block, see how it respects that. We're also inside this reclaimed bearish fair value gap. So we'll see if this grouping of PD arrays being the inversion, we also have a new week opening gap in here, and this bearish order block coupled with this bearish breaker, we'll see if that can continue to hold price. And line in the sand that would disrupt that perspective going lower would be if this midpoint gets taken out. And if this midpoint gets taken out and that market maker sell model proves to be incorrect, then we could switch to this being a potential low resistance liquidity run because it's a failure swing, and then potentially use a market maker buy model framework from this lower time frame perspective, using that inversion fair value gap as our second stage distribution area to map price with. Okay. So yeah, hopefully that makes sense. And that will about do it for the indices. So do you guys have any questions about anything? Hopefully it makes sense with what I'm trying to see. I want to see, with a gun to my head, this hold. Right, the bearish order block hold, the daily inversion fair value gap bearish hold. And I don't even want to see these get targeted at all. There's really no reason for these to be targeted because it's a balanced price range. There's no need. So it could retrace into that, great. If we get like this 2-hour or 1 hour breaking down, changing state of delivery, maybe it tries one more time to sweep some of this previous Friday liquidity. Preferably it doesn't. Preferably it opens up and gaps lower. Right? That'd be great because of the war. And then again, we would just be looking to target this. This is my main objective. Okay. Good morning, Fancy. Appreciate you spending time with us. Showed up a little bit late, so I encourage you to watch the whole video. But appreciate you making the time. Tony said, just waiting for things to play out. Yep. So yeah, I'm glad that everything makes sense to you guys. Hopefully you guys will watch the replay. And hopefully it makes sense to you as well. So yeah, everything is always present in perfect order. I love that statement right there. I love that. Because Tony, you're absolutely correct. But the thing is, getting you from a trader that doesn't understand the order in which things are done and how price operates to understanding the order in which things unfold, how order flow is represented, how to read it, how to be flexible, how to identify when something is not going to work out or not, understanding how to use timeframes to timeframes, asset to asset, how all of it works together, how PD arrays communicate with one another, the language that's being spoken by price. Getting you to that point from, not knowing, that's the struggle, that's the battle, both for us individually and for someone like me who's trying to teach. That's always the battle. And it takes time, and most traders are not going to be willing to take that time. That time could be 6 months, that time could be 3 months. That time could be less than 3 months, like one of my students named Harley. He did it. He understood in less than 3 months, and then ended up walking on his own in 6 months and became profitable 6 months later. So in a whole year from spending time with, me and what we do here, this process, right? Him being exposed to this as I think he was a teenager when he started with me. I think he's about to hit 21 this year. But yeah, from his, 3 months, right? His little 3-month period of learning before he discovered us, discovered what we do here in ICT. He was able to take it pretty quick. So it's different with everyone, obviously. And hopefully you guys feel that I've made it a little bit easier to achieve clarity and what to look for and what's important and why it's important and how things operate. And hopefully you guys can see the end of the tunnel a little bit more when it comes to consistency versus when you first started trading. Maybe you were listening to other people. I hope I've been able to bridge a lot of the gaps and maybe make things that you've previously been using a little bit more effective. But more importantly, I hope it's been building confidence in you guys, because, one of the main goals is obviously to build your confidence so you can do it on your own. And the way that I go about achieving that, which is kind of laying things out systematically in a structured manner, very detailed manner. We do, and being live every week for those in my private group every day. And then the fact that I don't give signals, right? It kind of, but then again, I do give signals, but it kind of, it doesn't really resonate with a lot of people, unfortunately, because they want me to just give them signals. Give me a model. It needs to work every single day. I can never lose. And, if we lose, this stuff doesn't work. If you guys notice, those of you that actually spend time, with us and on these calls and on the live calls all the time, you notice that we rarely get it wrong. And you can kind of put 2 and 2 together. We call moves that work, upwards of three trades that work every single day. Last week was a little bit different. It was like 2 trades that were called out, but like per day, but I didn't engage until Friday. And sure enough, we were absolutely lethal on Friday. Not just me, but many of the students that are in my private group. But we went 3 days without taking a trade. Right? Tuesday, Wednesday, Thursday, no trades at all. Friday came in though, we made back all the time that was lost. And that's the reality of trading. You may go, weeks without a trade if you're following rules and they just don't align, or maybe your skill set isn't there yet for you to identify stuff with high volume. There's nothing wrong with that. There's nothing wrong with not taking a trade. There's nothing wrong with taking 1 loss or 2. As long as you have a plan for it, it's within the plan. You're following the plan. It's not a negative thing. Monetarily, it's just like you're giving the market a loan that you're going to make back with interest when things fall in alignment, and you just continue to press on the process, press the system in, keep pushing into it, build your system, and then let time do the heavy lifting. Get better at higher time frame analysis, because, going back to what I said about how the higher time frames can heavily affect what happens on the lower time frames. Even if you're a scalper, it's still recommended to be on the those higher time frames. But when you're on the lower time frames and you want to catch bigger moves, say you start to feel you want to graduate. Say you feel you want to graduate from 20 to 30 points. Well, you need higher time frames to do that. So if you just completely disregard higher time frames because it's not the 5-minute chart and it takes too long, you're basically removing your ability to ever understand how to catch these huge, massive trades that run hundreds of handles. So maybe that's convincing enough for traders that do kind of hesitate with the higher time frame. I mean, I heard that and it convinced me, you know, it convinced me to really focus and live on the higher time frames. Because even if I'm taking 20 to 30 points, I want to be in a move that has the possibility to run hundreds of handles. That only comes from higher time frame liquidity sweeps, or liquidity sweeps or raids, whatever, and higher time frame PD arrays in general. Okay. And again, if you can find your model, say it's the 2022 model, if you can find your model on the daily chart, it's no different. So if the model looks like it's delivering from that daily chart perspective, you now have been able to put your entry tactic, your entry model for the lower time frames on the higher time frames, and either create a swing trading opportunity or a contextual idea that further reinforces whatever it is you're trying to do in that lower time frame. So the higher time frames have many use cases on the lower time frames, but most people are too myopic. They're too basic in their thinking to really even be able to discover this type of perspective and use case when it comes to higher time frames versus lower time frame analysis. You know, and multiple time frame confluence and overlapping contextual ideas, right? So yeah, very, very important stuff. So again, hopefully everything made sense so far. I think that just about does it for the indices. So now now for this next segment, we will now move on to gold and silver. Kind of do a rough breakdown of gold and silver. So what we see here on gold and silver, we see that gold is doing what I predicted it would do. If we go back in the last week, go look at when I talked about gold and silver, I said that it's probably going to hold up in here and it's going to get above this and we should continue to rally. This was an opposing PD array. It's that large wick. If it was going to be bearish, this would have rejected price, give us a failure swing mitigation block below this low. Also would have inverted this, and then you could see that order flow in that case would have then continued to march lower. We had SMT at the lows here, so that led to this big rally. I've been talking about that since it started down there, since it declined and hit that. That whole movement, that SMT is also happening at a weekly bullish order block. And nothing's changed fundamentally in the world right now for gold to not keep running, for silver not to keep running. They just came down and liquidated the hell out of people because there was a lot of hype. And this shows you that the market's controlled. They liquidated because they're going to keep going. There's nothing telling us it's not. There's no reason for them not to. It's going to keep going until, the financial system gets fixed or wars stop. But we have a double whammy, right? We have financial chaos in the United States, in the global economy, and we got wars breaking out. So that pushes people to gold and silver, for a safe haven. So I don't think that fundamentally is going to change anytime soon. So we got this. So I think I could just drag that over actually, so I don't have to do that. This is a wick 50% level. It's a order block 50% level. We rallied up. If it was bullish, any PD arrays that it meets that could be bearish should act as counter positions, so counter trend trading. If you're in a trend bullish, how do you frame out counter trend moves? Well, to frame counter trend moves in a bullish trend, you have to find an opposing PD array on the higher time frame. And then when price reaches into it, you can expect it's going to hit that as a speed bump, probably give a retracement back down to some other PD array, and then it'll go in the intended direction after it fulfills that, like this did. Rallied up, took buy side, hit an opposing PD array, gave you a start to a retracement. That retracement hit internal range liquidity in the bullish trend, and then it went from internal range liquidity, created a failure swing, so low, high, failure swing, mitigation block, type 2 dealing range, to then target the buy side. And now we change state of delivery again back in line with bullishness. So now we know, price is probably going to open up, potentially run back down into that. All of this is a balanced price range. This decline here has now been balanced with all this price delivery. So unless it's bearish and we're going to target sell side, this PD array should hold. This fair value gap shouldn't get traded through. This swing low should hold and stay intact. This fair value gap should never get remet. And as long as it retraces into this and holds that up to the 50% level, order flow will continue to remain bullish, and any rejection from an opposing PD array level will just be simply looked at as a reaccumulation for smart money buy positions at a discount price relative to where price is at currently, right? So that's how we'll be looking at any type of retracement in this price delivery going lower. It's not going to be, let's pick a top. It's going to be, okay, there's a top that's placed. What is it reaching for down below to set up further buys? Because nothing's changed, and that's just the way it is. I got the same opinion with silver, okay? So we'll see if that, we'll see if that changes in this asset. We have a new week opening gap in here. Price is really using, so it's going to be very interesting. So this order block, we have a swing low in here. We have the new week opening gap in here. We have this swing high, this high to that low. It's kind of sloppy, but I'm pretty sure it created a bullish breaker. Yeah, this high here to the low. Got a bullish breaker there for the silver delivery. And then again, we have this higher time frame daily FVG. I'm not going to make it a crazy color. Just make it dark. Okay, so one thing we can do, because that fair value gap is so large, like I did over here with that wick, we could do that here for the fair value gap. Give it some quadrants and eighth levels, like ICT has pointed out recently. I think he talked about it in early January, where he started mentioning the eighths. You could even go even further, which I think is overkill. It's, you don't even really have to have the eighths either. You could just use the quadrants. But if you like to be precise, like I do, there's nothing wrong with it. Just adds to another tool. So yeah, next objective here for silver. So we've pretty much filled in this entire fair value gap now. So that should act as an inversion level. That right there should be an inversion in there. Okay. So yeah, we got a high here, low, high, failure swing to take out that low. This low ended up taking this high out. So what did that do? It took out the origin, which is up here. You got this high. We got a low down here, high, failure swing. This low taking out this high in here on a larger scale, right? We got the high up here, low, high, failure swing. Breaking this high, we took this high. Now we may be putting this in jeopardy as well if the deeper it can go. And we could potentially see that as a market maker buy model. Gold looks even more convincing. So yeah, so we'll see what happens in here. It's all bullish for me. I'm not going to be bearish unless proven otherwise by breaking our invalidation down here. And yeah, that just about does it for gold and silver. So let me know if you guys have any questions. But yeah, with that being said, we will quickly move on to what Tony asked for earlier. And we'll go look at some currencies, or some cryptocurrencies. I'll probably just look at Bitcoin, maybe Ethereum, and XRP specifically. Because y'all know how I feel about XRP. Freaking love XRP, okay? Coursework. Oh, wait, I didn't even have to switch. I could just go. We already have it there. Speaking of the devil. Let me see. Also pull up oil too. Let's see. It's already kind of hit that gap in there, huh? Wow, isn't it funny? This is crude oil futures, and we have a stop run, shift, fair value gap. That's 2022 model. It's also a high, low, higher high breaker. It's also, for those that are in my private group, the Razor model. I'll let you go in and discover that. And no worries, Tony. No worries, brother. I'm here to help you guys, right? But yeah, if we look at XRP in here, I talked about this the other day. XRP is inside of a reasonable level. I prefer to see that XRP holds above the 50% here. If we do end up getting down below sub 1 minute or sub 1 hour, sub $1 time windows, or time window, what the hell am I talking about? Sub $1 price levels, right? If we get down below that, we may look to try to be pretty aggressive to close in the rest of that and offer sell side. I don't necessarily think, because we have this wick in here, I don't think that it's going to really need to go down there. Ironically, that wick is at 25% of this 6-month fair value gap. It's at 25% of it. How do we know? Well, you just go like this. Literally perfect. That is crazy to see how perfectly that is. This is a balanced price range, right? It's a wick with displacement, like in close proximity. So price trading down into this. Hopefully we get price holding in here, and then at some point, we need some type of, better news, more adoption. A lot of this, in my opinion, is them accumulating price. Big institutions are in adoption phase for XRP and cryptos like it. They're going to revolutionize the banking system. So that's their whole purpose. Like I've said before, I'm not going to go too deeply into it this time. But yeah, we'll see what happens. So we got this area in here. If it does get down below 50% and it closes, say, below this, and we get down below sub $1, what I'm going to be doing, I'm not going to give up on XRP. I will become aggressive, let's just say that, and get more. That's not financial advice. It's not for you to copy, but that's just my belief and what I'm doing. I don't encourage you to do what I'm doing just because I'm doing it. I encourage you to look into things that I talk about, make your own decisions, especially when it comes to crypto, because it's a wild ride. If you're not here for the next 5, 10, 20 years, which I am, it's probably best to make a shift in your mindset, because that's this asset. It drops 50% all the time, 30%. There's cycles that are vicious, shaking people out. So, but yeah, with XRP, we got this big wick in here. We got a low, high, lower, low. It's basically a breaker. We had one in here too, low, high, lower, low. XRP is ironically using breakers. Isn't that interesting? Algorithm seems to be the same. So yeah, pretty nice. Now, if we move around to Bitcoin, we talked about this. Talked about this quarterly low. I don't know why I had quarterly high marked. But yeah, I basically called this. I called this setup in here If you guys remember, if you, I don't really talk about crypto all the time, but we literally talked about this breakdown, this inversion, likelihood of this being taken. If this gets taken, that becomes a breaker. Now this price shouldn't return back into this. It should leave this open, right? It should leave all that open. Maybe it comes back to this wick, but honestly, we got a quarterly fair value gap in there. So I wouldn't be surprised if we return back into this quarterly fair value gap and then it rejects again. I mean, we could see price get down to damn near 50K. Wouldn't that be something, huh? That would freak people the hell out, that's for sure. We got this bearish order block here too. We got the wick in here. Got this wick in here. And again, we got that quarterly fair value gap. That is something that I'm highly looking at. Okay. So yeah, I don't necessarily think because we blew through it so aggressively, I don't think it really is going to have any interest unless it rebounds. If it rebounds and gets above this quarterly fair value gap, we may be in recovery mode. It may look to recover, but nothing's different that we're doing here than it is with the NASDAQ and the other assets. It's all the same stuff. We're looking for the exact same stuff, exact same process. The only issue I've had, which is what's kept me from even engaging in the crypto market, is the timing element. It seems like it's starting to finally get in line with the futures timing, AM, PM session, and all the other sessions, right? And the macros are still present. If you go into this asset or any other crypto and you look at the last 10 minutes, first 10 minutes of every hour, you still have the same characteristics. You know, if you take the open price for every hour, you know, you get power 3. You know, if you take Sunday's open price, well, the time that futures opens on Sunday, if you take that time and you put it on crypto and you extend it, even though this is a 24-hour period, right, it has 24-hour trading, price still refers to these levels. This is something most people don't know, by the way, about crypto and ICT concepts. If you take anything that may not be present showing in the chart, like the open prices, and you put them onto the chart in crypto, you'll see that it's exactly the same. It's just the timing it's been a little bit off over the years. I'm not sure why. Still trying to figure out why that is. Maybe eventually I will figure it out. But honestly, you could just swing trade crypto. You know, you don't have to day trade everything, you know. And if the timing element on the lower time frame is going to be not really that great, or has a discrepancy a lot more than you're comfortable with, and you find it difficult, just move up in time frame. Enter on like the 15-minute chart, you know. London still operates like London does. You see that? London low all the way through PM session. Look at even on the weekends. And in this instance, it pretty much operated like NASDAQ does, using the New York AM session, or I guess it's still in AM session, right? We got the open price here, drag that over. Accumulation, manipulation above the open price, distribution, redistribution. Breaker. Right? So I'll leave the rest of the study to you to go do for crypto, but hopefully that was kind of eye-opening for those of you that may be interested in trying to mess with crypto or start observing it. You know, everything that we do here is universal. It can be applied to anything. And the way that we do analysis on this higher time frame is also a way that you can consider long-term ideas. Like if you're a long-term investor, again, this ain't financial advice. This is what I do. You know, I use the same models, the same principles, the same ideas. And whenever I'm looking to add positions to my crypto, which I don't encourage you to do, this ain't financial advice, but when I look to add trades or add things to a portfolio of mine in crypto and on stocks long term, right? I'm basically doing this. I'm doing everything I do in the lower time frame. Well, everything I do in the higher time frame that I'm looking for, I'm using as a framework for how I manage positions on the higher time frame, long-term investing tactic, right, or perspective. Does that make sense? I hope it makes sense. Right, so you have a run on stops, you had a shift in market structure, fair value gap in there. That could be a position for day trading, right, or swing trading to go short, target the quarterly low, right? And when it comes down, or when it tags levels like this, say it, really, really accelerates. So you get like this low to that high. You get your projection. If you're trying to do like profit taking, again, not that I'm encouraging you to do anything. Wow. Oh my goodness, that's amazing. Even the projection that we use on futures or any other asset, even the projection characteristics at 2 to 2.5 standard deviations literally lines up perfectly with the retracement, because that's the 2.5 standard deviation. I never, there's some things I haven't applied to crypto. Every time I apply stuff and it just works and like exactly the same way that it does, I mean, man, it's very eye-opening. Once you learn, it opens up the door for everything, Tony says. Absolutely. As a trader using these concepts, you can manage portfolios for yourself, if that's what you choose to do, which I don't encourage you to do. You got to make that your own decision. But it opens up the opportunity to do so. And then manage either whether you're a long-term trader or if you like for a retirement account, or if you're a day trader, or if you're a swing trader, or if you trade crypto, or if you trade gold and silver, or if you trade anything that's in these markets, you'll be able to have a process, and you don't have to redo anything. You don't have to relearn anything. You just kind of have to learn the characteristic and behavior of the asset you're trading, because they're all different. They all have different personalities. Like the S&P is less violent than the NASDAQ, but the Dow does whatever the hell it wants. Crypto and all these other asset classes, even commodities like corn and wheat and silver and cocoa and all these things, they all have their own characteristics, but they work within the same umbrella concepts, being ICT concepts. And liquidity, based on liquidity and inefficiencies. Rebalance to imbalance to rebalance. Stop rate to opposing liquidity, or PD array. It all does the same stuff. Kill zones, everything's run off time. It doesn't matter what asset you're trading. You still use the time elements. Forex has its own little time behaviors. They have their own little session navigation too, and placement. But then there's things like indices that have their own little quirky characteristics too. Like currencies don't have AM and PM session. They just have, New York session, and then London close is when currencies generally die out in New York, right? For London assets. And then of course, like I just said, go back and study the futures, timing. Go in and study the macros. Go in and study your model. Go in and study what we use on these higher time frames, right? Like displacement to rebalance to displacement, consolidation, displacement to rebalance, consolidation, displacement, right? If it breaks out higher, taking external range liquidity, the next observation should be some type of internal before it goes external again. It may not. It may just keep ripping, but that's the anticipation. Because why? Because power 3 is constantly in the market. Every 5 minutes, every 1 minute, to every daily candle, to monthly candle, to quarterly, to yearly candle, Power 3 is in the market. Market maker models are in the market. Market maker models are in crypto. Market maker models are in futures. Market maker models and all these things are in commodities. I mean, I hope you get the point, right? And again, everything has its own little quirky things. But yeah, just going back to what Tony said, once you learn what it is I'm sharing with you, what ICT teaches, once you get familiar with this stuff and the mindset that we develop and the mindset that I encourage you guys to have and master risk management, we're not able to fathom exactly what it is that we have in our hands in terms of opportunity. It's unlimited ceiling, but you just have to do the right things and you have to be disciplined and you have to follow the rules, right? But once you submit to it, once you do submit, once you do have this stuff organized and you've put in the work and you obsessively study and make sure that you are learning how to better your future with this market, I mean, the sky's the limit. Once you get that stuff established, like Tony said, the world opens up, not just doors, not just the door. The whole world is your door. Okay? And you kick it open once you learn this stuff. At least in the world of investing. And you can do whatever you want with it. You could be whoever you want, do whatever you want. I mean, it's a blessing that it's hard to describe really. Unless you've just been there, unless you've experienced it, it's hard to really encapsulate how it feels. ICT mentioned this before too in a Twitter space. It's nearly impossible to describe the liberating feeling you get from knowing that, I just basically separated from society's need, from the way that society works, needing a job, needing this, needing that. But in order to do that, it takes a lot of work, especially in this. And more of the work has to do with learning the technicals. I'm biased, obviously, preferably the way that I do them, the way that ICT teaches, and then just getting out of your own way. Once you do that, I'm telling you, there's nothing that can stop you. There's no job that you'll ever need to go back to. There's no job that will even make sense to go back to because, if you make $300 to $500 a day, depending on how much you make, which most people don't even make that, but if you make that at your job, working 8 to 10 hours a day, maybe more at times, and then you get into the market and you make $500 in 20 minutes with one contract on, across like 3 or 4 funded accounts in 1 minute, in 1 day. I mean, it just doesn't make sense. And then you build up enough money to have a personal account, so you don't even really need the funded accounts. And honestly, you're set for life. You're set for life, and you don't need a lot. If you can get, a reasonable amount in your account, if you can learn the skill set, first of all, learn yourself, master these inner things. And then once you get to the point where all you need is capital, if you trust yourself and you've done the work, the pre-work, the hard work, the stuff that nobody does, once you get your hand on capital, whether you borrow it from somebody or like a friend or family lends it to you, maybe you prove yourself to a friend or family or a rich uncle, or the other route, you just go to get a funded account or a couple, stack them together. The opportunities are endless, and the main goal, of course, at the end of the day should be to get a personal account. Save every dollar that you possibly can with the goal in mind that you have your personal account and for a fact this is going to work for you. Otherwise, you'll hesitate to even do anything that'll set you up for the moment you arrive. If you could just put aside stuff for yourself, if you choose to do this, obviously. I'm not encouraging any of you guys to do anything with your finances. That's your job. But for those that maybe would consider it, these are some of the things you want to think about, and some of the routes you could take, and the road that's ahead, and the gold that's at the top. The gold that's at the top of that mountain of, trial and tribulation, of sleepless nights, feeling like a failure, feeling like it'll never work, family doubting you, friends doubting you, people calling this stuff a scam. People saying that this doesn't work. The market is a casino. All this stuff. It may be a casino for some people. It's not a casino for us. Just like how gambling for professional gamblers, professional poker players, it's not gambling to them. They have consistent wins. They know how to win consistently and work the system that's at hand, that's controlled, that's rigged. They learn to deal with that rigged system and be massively, wildly, unbelievably successful. This is no different. It's just a different type of casino. And again, just like how casinos can be gamed, how professional gamblers have a tactic that they can use or a process they can build to be consistent, same thing is true in the markets. It's literally no different. So yeah. I guess I've kept you guys here for as long as I've planned on keeping you. Hopefully you guys got value from this call. Okay. Hopefully it's enlightening every single week. Hopefully you guys learned a lot. It's unfortunate that a lot of people don't stay on long enough to get the true value and what this community provides and what I provide. But hey, you can't save everyone, right? It's just kind of the way it is. But yeah, with that being said, God bless you guys. Appreciate you for hopping on. As always, we'll be live again on Tuesday. There's not going to be any news, so it may be a kind of calmer session where we don't really do much. We really got to feel how this NFP week and the fact that we're in active war right now, how that's going to affect the markets. I know that gold and silver is probably going to keep skyrocketing because of the fear. I know that oil and gas are probably going to absolutely rip people's freaking heads off. Yeah, I think it's going to be very crazy, in all honesty. But yeah, we'll see what happens. Gas and oil both rallying aggressively ahead of the war. Isn't that interesting? Just the talk about war with Iran rallied price up. It already began. So yeah, the equal highs up here look nice. So keep your attention up there, okay? So yeah, with that being said, like I said, thank you guys for your time. God bless you guys. As always, your time's appreciated. Hopefully you guys got value, and let me know if you need anything, either in DM or those of you that are in my private group. Just let me know if you guys need anything, and we'll get to it. But yeah, with that being said, I will see you beautiful people back here bright and early on Tuesday at like 6 o'clock, maybe 5. Depends on how I feel, if I want to do it earlier or later, because there's no news. And those of you in my private group, I will see you beautiful people bright and early tomorrow morning, as always. All right. So yeah, have a good rest of your day, and keep your eyes on the open. Right. We'll see what happens. All right. So yeah, have a good day, you guys.